Hello everybody and welcome to the EAB CPD programs. My name is Bashier Adams and I'm going to be responsible for taking you through the budget and tax update relating to the 2016 budget. The objective of today's session is to obtain an understanding of the 2016 budget reforms, and we all know that's been very exciting and there's been lots of hype around that, and the various tax proposals, and to review certain relevant topics which could impact individuals and companies. I need to stress at this point that this course, this part of CPD, is not designed to go into the detailed aspects of each of the relevant topics. It does, however, give an overview of specific topics that you may encounter as estate agents in practice. So what will we look at today? We're going to look at the budget highlights, some aspects of the Tax Administration Act, and we all need to know about the Tax Administration Act. It's that act that gives SARS the big stick to do whatever it is that they need to do. We're going to look at capital gains tax. If you work in the property market, you will be confronted with capital gains tax. It's just the way it is. Transfer duty, well, who am I to talk about transfer duty? You are all the estate agents. You know more about transfer duty than I do, but we'll explore what it's all about. And then value-added tax. We all know what VAT is, but we're going to look at how VAT, in certain aspects, impacts the property market. So, let's get to the budget. By way of introductory comments, on the 24th of February 2016, South African economic analysts, international rating agencies, and the country's public waited to hear from Finance Minister Pravin Gordhan when he delivered what appeared to be, or what was billed by many to be the most important budget in the history of South Africa, given where the country finds itself. This budget, the background of this budget was that Pravin was faced with economic problems. He was appointed at the very last minute in December last year, with the holiday period looming, with South Africa facing economic challenges, with certain political decisions being made that business didn't agree with. And what did he have to do? He needed to assure the nation that any recession that South Africa could possibly be encountered with could be avoided. This in spite of sluggish growth. We haven't been growing as a country. All of Africa has been growing and South Africa's lagged behind. When the likes of Ethiopia and Rwanda are posting growth rates of 7 and 8%, we in South Africa are battling to make 2%. Our unemployment rates are rising and rising, particularly amongst the youth. Labor unrest is continuing to plague us, particularly in the mining sector, and we know that South Africa is predominantly, the economy is predominantly driven by resources. And if our resources aren't working for us, then we need to look at take a good hard look at ourselves and understand that we do have issues that need to be considered. Pravin needed to restore both domestic and foreign confidence in the strength and credibility of the fiscal and monetary policy. Again, since December last year, the rand went from 12 rand 50, and we peaked at 17.99 at some stage. We weren't there for a long time, but we were at 17.99. Now, anybody that wants to generate confidence in your economy against the sliding currency, you've got to challenge any which way you look at it. Pravin also needed to convince the rating agencies that collectively decision makers are doing all that they can to avoid a credit downgrade. Now, if we think about it, who are the decision makers? The decision makers in this instance happens to be, one, the politicians, the president, cabinet, right? Incidentally, ladies and gentlemen, we have the second largest cabinet in the world. If you didn't know that, now you know it. We've got the second largest cabinet in the world, and guess what? You and me, we pay for that cabinet. We pay for them. What they do impacts all of us, and we fund it. It's as simple as that. So, what would happen if we did get a credit downgrade? South Africa would be termed a junk investment destination. Now, what does that mean for us? That means we could be faced with lack of foreign investment. our cost of borrowing in the international arena will significantly escalate. We could be faced with spiking interest rates in South Africa. And all of this doesn't bode well for an economy. It doesn't bode well for an economy that needs growth to create employment. So, did the 2016 budget presented by Pravin Gordhan give us the relief that we need, give the rating agencies the confidence that they need in the country? Many don't think so. Many don't think that enough was done. Many think that more should have been done. There was a lot of stuff bandied around before the budget speech. VAT should increase, the top marginal rate should increase, the rich should pay more tax, there should be cutting in the size of the cabinet. And these are the kind of things that people think Pravin has fallen short of. Some of it is little mention of underperforming state-owned entities. Ladies and gentlemen, need I say more than South African Airways? Right? We are probably one of the only countries in the world that government still has a wholly owned interest in the national airline. The other one, if I recall correctly, is Vietnam. Now, we know where Vietnam's economy is, and it's certainly not where we want to be. Right? So SAA is a problem, but SAA, make no mistake, is not the only problem. Eskom, I mean, the fact that I can stand in front of you today and we're keeping the lights on doesn't mean that the lights are going to be on when I present live to the participants in all the rest of it. And that's something that we need to make contingency plans about. So, ladies and gentlemen, that is the stuff that we don't think has happened. Pravin didn't, he made little mention, and he only mentioned SAA when it came to underperforming state-owned entities. He made no mention of government's plans to combat mismanagement despite some cost-cutting measures. So he did say, we're going to look at government spend on compensation. We're going to look at government spend on, and cut that by 25 billion rand per annum over the next 3 years. But is that enough? Personally, I don't think so. I think a lot more needed to be done. We can't only cut costs, we also need to raise revenue. No mention was made in the size of the cabinet and the public sector wage bill. And by way of comparison, when former President Nelson Mandela was president, we had 18 people in cabinet. Right? We had 18 ministers and deputy ministers. We now have over 133 people that sit in that cabinet. Now, you guess why there's so many there. And I have my opinion on why there's so many there. And some things are better left unsaid. Right? You see the picture on the slide? Austerity ahead. Now, we've all heard the horror stories about Greece and what has happened there with austerity when that country literally imploded over the course of the last few years, where they needed bailouts from the World Bank and they needed bailouts from the European Union, and the Germans have been bailing them out all the time, and the Brits are sitting and saying, do we actually want to be part of an EU where everyone is not bringing their part? So these are all the kind of things that's happening, and we need to realize that we are not isolated in South Africa. All of these things that happen globally and in Africa does impact us. For example, one of the biggest lowlights of my financial career was in the last 18 months when Nigeria was billed as being the biggest and strongest economy in Africa and not South Africa. That's not a nice thing. We know that. We pride ourselves in what we do, in who we are, in how resilient we are. And all of a sudden some, what do we call it, non-industrialized large West African nation becomes the biggest economy in Africa. How can that be? I mean, we South Africa, we the powerhouse of Africa, but we're losing it. We're losing it. So we've got to start putting things together. We can't ignore what social media does. Social media in today's day and age cannot be ignored. So what I went to do was I went to go and browse the web, and I went to go and see what did the guys on Twitter have to say about the budget. What are the opinions from you, ladies and gentlemen, the normal people on the street? What did they think about this thing? And I quote, the first one says, typical of Gordhan. He raises the fuel levy as he did in the past, not realizing that when you increase the price of energy, it affects the price of everything else. Now, let's think about it. Put up petrol, goods need to be transported into the stores, the people need to be transported to get to work, to be productive, etc., etc. Now, when you think about all of those things and you raise the fuel levy, then we impact the price of everything else. And not only did we raise the fuel levy, but we'll touch on this one a little bit later, we also raised the road accident fund levy. Now, that particular entity is just one waste of time. I've been doing tax and budget updates for the last decade, and I have yet to come across a year where we did not increase the RAF. And the only reason we increased the RAF levy is because they're perpetually bankrupt. There's no way in wanting to, there's no intention, there's no showing of intention to get out of there. For those of you that follow the legal press and financial press, you may have heard about a gentleman called Mr. Bobrov, right? Mr. Bobrov is one of these guys, the lawyers, who's been plundering the RAF. He's been charging exorbitant fees. He's been getting to victims of motor car accidents. He's currently on trial to decide whether he's going to stay accredited as a lawyer or not. I don't know why he's going to be on trial for that. I think it's a foregone conclusion, but that's me. We're not going to go through all of that in this presentation. The next comment was, thanks. Sugar tax, a futility. The poor and millions of health fanatics don't even use sugar, so what's that going to help? Right? And the petrol levy, what was Gordon thinking? A petrol rise is an increase in commodities and food. I wonder if Van Rooyen would have done a better job. Now, ladies and gentlemen, when we think about that, we need to put our heads out and think, which Van Rooyen are we talking about? And if it's the same one, then we don't know. Okay, 457.5 billion for government handouts, social grants. Ladies and gentlemen, in a country where we have less than 5 million people that actually pay tax, we provide grants to 18 million people. Now you're going to sit down, how can the books balance? They just don't balance. And in the comments, this is not my words, this is the words of someone out there that looked at it, said for 457 billion rand, we could build 10 Medupi power-sized power stations, and it would cost less. Plus it will create permanent, sustainable jobs and infrastructure, widen the government's tax base that would last decades into the future. Now, you know, I'm one for social contribution and the social aspect of economy that needs to be taken into account and all the rest of it. But if you look at a comment like that from a normal person in the street, it makes absolute sense. It makes absolute sense. We can't deny that it is unsustainable for less than 5 million taxpayers to support a country of 55 million people. Just doesn't work. The markets don't seem too impressed with Gordon's budget, as the USD exchange rate weakened to above 1550 again. Now, ladies and gentlemen, interesting, I was watching this exchange rate as Gordon was talking, and it was falling. The day of the budget, we fell 2%. We ended on 1570, I think it was that day. But what a lot of people didn't know was at the same time that Gordon was talking about the South African budget, the ratings agencies cut Brazil to junk status. They downgraded Brazil. Now, the emerging economies work where they impact each other. And when Brazil was cut, we felt they sneezed and we caught a cold. That's what it came down to at the end of the day. So that's that. And then the last one, and possibly my most favorite of the lot, there's more tax increases on spirits, there's more tax increases on fizzy drinks, but we're in a drought. What must we drink? Eh? What do we drink? You can't drink spirits, you can't drink fizzy drinks, there's no water. What must we drink? Right? So these are all the realistic stuff that gets said. And one can't ignore that that's the way the people of South Africa feel about the budget. Right? Okay, so what are we getting? I must say that Mr. Gordon, one thing he does do, those suits are perfectly cut. Right? When he stands up there, he projects the image of a confident man. He comes across with a presence, there's confidence. And when he stands there and he's going to spend 1.3 trillion rand, then I think it gives you a right to be confident. Right? So if we look at it, what do? Our budget deficit will fall from 3.2% in 2016-17 to 2.8% in 2017-18 and 2.4% the following year. So we're going to drop our budget deficit down to 2.4% from where we were. Not too long ago, if my memory serves me correct, it was 2006 when former Minister Trevor Manuel actually budgeted a surplus where we had more money than we were able to spend. Now, something must have gone really, really wrong for us to have moved from there, right, to a place where we don't have enough revenue to support our current spend. The debt stock as a percentage of GDP will stabilize at 46.2%. To put this into context, debt stock is what we borrow as a country, right, where we borrow from. GDP is the aggregation of everything that is spent and produced in the country, right? So we borrow close to 50% of what we're able to produce. That's what we do. Government will lower the expenditure ceiling by 10 billion in 2017 and 18. I mean, they did come out and say no more lavish parties. They're not catering at conferences and at parliament and all of these things. I don't know how that's going to make a 10 billion difference, but that's what they said. And 15 billion in 2018-19 by reducing the public sector compensation budgets. What are they saying? They're saying we're putting a freeze on the posts in the public sector. We are going to not fill additional posts. We're not going to create new posts. So we're going to save, in that way, we're going to save 25 billion bucks over the next 2 years. Now, let's think about it, right? 25 billion bucks, we're spending 1.3 trillion rand. Is that enough to avoid downgrade, avoid junk status and all of these things? I have my doubts. Let's put it that way. An additional 18.1 billion of tax revenue will be raised in 2016 and 17 with an additional 15 billion in each of the subsequent 2 years. What are we doing? Right? We're taxing people. So we're raising, notice, we're saving 10 billion on the expenditure ceiling, but we're taxing you 18 billion. Right? So when we look at it, that's what's happening. We take more than we give. And that's really what it comes down to. Government has responded to new spending needs without compromising expenditure limits, and the interpretation of that is they've reprioritized certain things from certain areas and they've put it somewhere else. I mean, one of the things that we can't ignore is fees must fall. Right? We can't ignore it. So government needs money for fees must fall to put into higher education, and they've got to get that money from somewhere else. So they've reprioritized certain funding in terms of what they want to do. So what does it look like, and how do we look going forward? In the 2015-16 year just ended, or government expects to end end of March, they estimate revenue of 1.2 trillion rand, expenditure of 1.38 trillion, and a deficit of 157 billion. In 2016-17, our deficit comes down to 139 billion, and so on and so forth. Now, ladies and gentlemen, it is important to understand that 157 billion going down to 123 billion needs to come from somewhere. That's money we don't have, right? But we're spending it. We're projecting to spend that money. We don't have it. Where do we get it? We have to borrow it. We have to go to the international community and we have to go and borrow 157 billion this year, 139 billion next year, 135 billion the following year, and 123 billion the following year. And you think about it and you say, nothing's coming down here. Everything's going up in terms of the bad stuff. All the good stuff is rising by a percentage that's less than that, but the bad stuff is just going up all the time. So what are our spending programs? How are we going to spend our money? We've got this 1.3 trillion rand worth of revenue that we're going to get in. How are we going to spend it? 457 billion on social grants. So we're going to take 18 million people in South Africa who don't work, who gets a grant every day. Granted that that grant is not sufficient to sustain a household, but there's still 18 million people that depend on that grant for their sustainability and their livelihoods. 93.1 billion of transfers to universities. Why do we need to transfer funds to the universities? Because we put a zero cap on fees this year, because the students stood up. And ladies and gentlemen, it's important to realize when the students do stand up, we are forced to listen. One can compare that to the Arab Spring. The Arab Spring, when Libya fell, and when Egypt fell, and when Tunisia was in crisis, the Arab Spring, all of those things were started by the students. The uprisings started by the students. So we would be naive to ignore what the students have to say in South Africa. 707.4 billion on basic education, including 49 billion for subsidies for schools, 38 billion for infrastructure, 14.9 billion for learner and teacher support materials. Ladies and gentlemen, we spend more on education than our peer countries by some distance. What is not right, or what doesn't add up, is that the quality of our education is amongst the worst in the world. In terms of an assessment, the quality of our education is among the worst in the world. And that's a problem. Because if we're not educating and training people going forward, then we're not only are we creating problems in present day, but we're creating problems for generations to come. 108.3 billion for public housing. Public housing has always been high on the ANC's agenda, and we know why. So I must say I don't have a problem with that. But also bear in mind it is an election year, so we need to do things. 102 billion for water resources and bulk infrastructure. In the last 2 days, there's been full radio reports that the water in and around Johannesburg area, particularly the Yeovil reservoirs, etc., due to maintenance has run dry. So we need to start refreshing, if we can call it that, our infrastructure. 30.3 billion on the expansion of access to of poor households to free basic services. So we still give people free water, and we give them free electricity and all of those things to poor households who can't support it. Interestingly enough, I haven't checked this statistic, but I'm pretty sure that those poor households are also the beneficiaries of the grants in many instances. 13.5 billion to Metro Rail and Shosholoza Mail to subsidize passenger trips and long-distance passengers. That's a brilliant thing. Only if we look at what I think it was Metro Rail or Praza did recently when they bought locomotives, and the locomotives they bought were the wrong locomotives, so it couldn't be used in any event. So we'll just give you another 13.5 billion to buy more locomotives because you bought the wrong ones in the first place. 10.2 billion for manufacturing development incentives. Now, ladies and gentlemen, that to me is not nearly enough. That is where we need to spend money. We need to spend money on internships, on manufacturing facilities. We need to incentivize stuff. So we reduce the cost base of our manufacturing ability so that we can export and we can get those things done. So that needs to get done. 4.5 billion for the National Health Insurance pilot districts. I've said this when they first bandied around the National Health Insurance, and I'm saying it now. South Africa cannot afford the National Health Insurance Initiative. For all the good intentions in the world, we can't afford it. The USA can't afford their National Health Insurance system. How can we afford it? Let's just think about that. That's really what it comes down to. All right, the budget overview. What are we spending our money on? Basic education, a total of 228 billion. Health, 168 billion. Now, 228, 168, and our hospitals are falling apart, ladies and gentlemen. Our public hospitals are falling apart. Defense, public order and safety, 181 billion. Higher education, 68 billion. Economic affairs, 238 billion. Human settlements and municipal infrastructure, 182 billion. General public services, read in there, wage bill, parties, flights, accommodation, all of those nice things. Read in there, 73 billion bucks for the year to come. But we're cutting it. Came from 97 down to 73. So we did cut it, and hopefully it's going to make a difference. And then Social protection, 167.5 billion. Right. Our total expenditure is 1.3 trillion that we're forecasting to spend next year. Now the next line is what really, really irks me. We spend 147 billion rand next year on interest on our debt. Now, what can we do with 147 billion rand as a country? And those are the things that we need to think about. If we can replace debt with foreign investment, real investment that creates jobs, that creates infrastructure, that builds plants and factories, etc., 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 that we can put people in, then we can halve that and we can create employment, we can do all of those things. But to get that right, remember the previous slide? We've got to increase our manufacturing incentives. We've got to make ourselves attractive for people to want to come here. And that's what it comes down to at the end of the day. So now that we know what we're spending and what we're spending it on, who's paying? Who is really paying for all of these things in the country? And let's take a look at it. That's the number we're looking at, 2016-17. That's the budget that we're talking about. The taxes on income and profits is 668 billion. So you, me, our companies, our wives, everyone, all our relatives that are working, we contribute 668 billion out of 1.3 trillion. More than 50% is what we contribute. And how do we contribute that? Our personal income tax makes up 441 billion. Corporate income tax is 198 billion. Now remember, corporate income tax assumes that companies are still profitable. If companies tank at a faster rate than what we expect them to, that number comes down. Taxes on payroll and the workforce. So over and above the personal income tax that we pay, the pay as you earn that we pay. So that's the taxes on the payroll. Taxes on property, that's your transfer duties, etc., etc. That makes up 15 billion. VAT makes up 301 billion. And then taxes on international trade, that's customs and excise, etc., etc. And that's where we get the 1.1 trillion of income from. So now that we know who's paying that, remember that 441 million. Remember that billion. Remember that number, because I'm going to come back to it later in the presentation. So let's get into this budget and let's see. We know what the numbers are. So SARS said, and the Reserve Bank has come up with a voluntary disclosure program in respect of offshore assets and income for the period 1 October 2016 to 31 March 2017. What are we doing? We're targeting assets of people that haven't declared it. So if you've still got assets offshore, ladies and gentlemen, now's the time to think about it. Because on the 1st of January 2017, the new OECD cooperative guidelines come into place where different countries report and assist each other with uncovering assets of other countries. So if you've got it there and it's hidden in a nest egg, you've got to think about whether the risk of keeping it there outweighs the benefit of not bringing it back. Now, and this is my personal view, I believe that there's a lot of people out there that when they weigh up the political and economic risk that they faced within South Africa, would rather take the chance of keeping their wealth outside. So is there enough incentive for that wealth to come back? I'm not sure that is the case. Right? Capital gains tax, that impacts you guys. The tax inclusion for individuals and special trusts, insurers and individual policy holders increases from 33.3% to 40%. So we're taxing you more on your capital gains. Pre-October 2001, ladies and gentlemen, a mere 15 years ago, we had no capital gains tax in South Africa. Now, 40% of any gain is taxable. For any other taxpayers, the inclusion rate increases from 66.6% to 80%. Other taxpayers, companies, trusts, etc. The budget makes proposals to prevent tax avoidance through trusts. Assets transferred via loans to a trust to be included in the estate of the founder and assumed to mean the donor or the lender. On death and infancy, loans to be categorized as donations. Now, if you look at that and you read it, it's a mouthful. It really, really is a mouthful. But if you're going to analyze it, and I've done it, it's what I do. I advise clients. I work with trusts. I've done it. As it stands, as they announced it, it just doesn't make sense. Because it's double taxation all the way through. It's double taxation all the way through. And the basic ambit of tax, is that income that is being taxed shouldn't be taxed the second time. So that's there. Don't take my word for it. Speak to your personal advisors, your accountants, your auditors, etc., etc. Consider what it is. But I can tell you, gone are the days where trusts could be used without anyone looking at them. Transfer duty increases for properties greater than 10 million. The rate goes up from 11% to 13%. We've just added an extra bracket to that one. So again, what are we doing? We're pushing for revenue. That's what we're doing, is we're pushing for revenue. The general fuel levy will increase by 30 cents per litre on the 6th of April. That's the general fuel levy. With that goes the RAF levy. That is an additional 80 cents per litre that comes in on the same day. Ladies and gentlemen, when you're going to work it all out, just under 4 rand of every litre of petrol goes to government. So our cost of petrol should be around 8 rand a litre. We're paying around 12 rand a litre, more or less. A 6 to 8% increase in excise duties on alcoholic beverages and tobacco products. You know, I understand where this comes from. We punish the so-called sinners, right? And they pay sin taxes. But I promise you, somebody who drinks excessively, he'll pay the 6% and he'll drink. And somebody who smokes excessively, right, will pay his 6% and he'll continue smoking. Then we have a tire levy that comes in at 2.30 rand per kilogram on the 1st of October. Now, ask yourself, why do we have a tire levy? Why? Anybody, think about it logically. Why do we have a tire levy? The reason we have a tire levy is touted as being, so government says, it's to assist with the recycling of tires, etc., 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 from an environmental perspective. Great stuff. I mean, we didn't pay for plastic bags 20 years ago, now we pay for plastic bags. We didn't pay for tires last year, now we're going to pay for tires. That's what it comes out. But did the thought ever cross your mind that maybe those little cages and gantries and stuff that they've got on the N1 is not working the way it should be working, and we need to ask road users to fund those things in another way? Ever thought about it? I'm not saying it's what it is, but you guys can think about it. All right. And then the tax on sugar-sweetened beverages. Again, what do we say? You must read the paragraph in the budget. For decades now, obesity has been a long problem, this, that, and the other. So for decades, why didn't we do anything about it? Simple, right? Because for decades, we didn't need the money. We now need the money. That's what it comes down to at the end of the day. Call it the sugar tax, call it the salt tax, call it the garlic tax, call it the beetroot tax, call it whatever you want. It's a tax, we're paying for it. And that's what it comes down to. All right, so the tax proposals. Now, we move off the budget. Budget is macroeconomic, big picture stuff. We go specifically to the tax proposals. An amount of 9.5 billion will be raised through an increase in excise duties, the general fuel levy, and the environmental taxes. So, our tire tax, our increase in excise duties, the 30 cents fuel levy, and I think we're putting up the tax on the plastic bags as well, right? So that gives us 9.5, but we're going to get 9.5 billion there. Limited fiscal drag relief of 5.5 billion will be implemented for individuals focused on lower and middle income earners, and we'll go through that one in a little bit more detail. But it's interesting when people look at this thing and they say 5.5 billion tax relief, and everyone thinks, what a great budget, right? But we just said to you now, he's taking 9.5 billion away from you in something else. So he gives you and he takes away. Maybe we should start calling Praveen Robin Hood, takes from the rich and gives to the poor. Adjustments to capital gains tax and transfer duty to raise 2 billion rand. Again, what's that? It's a tax on the wealthy. That's what it comes down to. The poor and the people on social grants don't own the property. And they certainly don't own property in excess of 2 million rand, which is the CGT exemption. Government proposes to introduce a sugar tax on 1 April 2017. Why? Because we're all obese and we don't exercise enough and we're promoting healthy living and all of those nice things. And ultimately, they just want the money. And that's what it comes down to. And then we have our tire levy or road levy or whatever levy you want to call it. Right. So, Again, who's paying? Personal income tax pays 37.5%, corporate income tax 17%, VAT 25.6%, fuel levies 5.5%, custom and excise 4.6%, and then we have a number of others. Others include, for example, things like mining royalties. So the mine and its minerals belong to South Africa. You can mine it, you can profit from it, but then you pay government a royalty on that. That's how that works in a nutshell. This is the most interesting slide that you will have here today. Right. We have a total of 13 million registered taxpayers in South Africa. That's what we have. 13 million registered taxpayers. Out of the 13 million registered taxpayers, 6.6 million pay no tax because they're under the threshold. So who falls in there? Domestic workers, all the lower end blue collar staff who fall under the tax threshold, so they earn less than 72,000 rand a year. Right? They pay no tax. So now we take 13.3 and we take 13.7 and we take 6.6 off that. What we left? We're left with 7 million taxpayers. All right. If we look at this table, 70,000 or people that earn between 70,000 and 150,000 make up 36% of the tax base. Those that earn between 350,000 and 500,000 make up 11% of the tax base. So as the earnings get higher, the less people we have following in that bracket. Until we get to those who earn more than 1.5 million rand, there are only 94,000 of them, making up 1.3% of the tax base. Interestingly enough, so we see as the earnings increase, how the absolute number of taxpayers decrease. Right? When we go further, so that's the number of taxpayers, then we go to the income tax that is payable by these taxpayers. And if we look at that, watch how the number has an inverse correlation to that number. Right? So if we take from 497,000 down to the 94,000, we have roughly 900,000 taxpayers that falls in there. But if we take 900,000 taxpayers and we take 17% and 11%, that's 28%, and 12%, that's 40%, and 23, that's 63.5%. So 900,000 people in South Africa pay 64% of the income tax bill. Right? And if we're going to look at it, and we take it from there, that's 7%, 10%. So 13% of the tax base pays 64% of all the taxes. Now, if that's not food for thought, what is? And to prove to you that these numbers make sense, remember I said to you earlier, remember the 441 billion income tax? There it is. All right. So the disparity is clear and evident for all to see. All right, ladies and gentlemen, we're going to move into the tax side of things. We've pretty much covered the budget and the tax framework. Very simple. The framework for tax computation in South Africa is gross income, all the income you earn, less exempt income, right? So any income that may be exempt in terms of the Act, which gives you income. We are permitted certain deductions, things like pension fund contributions, things like medical aid credits, etc., all of those nice things. And then we increase it or decrease it by, or we include any capital gain that we may have, and that gives us the taxable income. That taxable income then gets applied into a table. Right? So if your taxable income happens to be less than 188,000 rand, you will pay 18% of that. If your taxable income is between 406,000 and 550,000, you will pay 96,000 plus 36,000 of any amount over the 406,400. So we work on progressive tax tables in South Africa, and that's what we need to have regard to when we take into it. And that's where the taxable income comes in. We are entitled to rebates, so we get a rebate, a primary rebate of 13,500 rand of tax. So if you had tax to pay of 13,500 rand, you'd get a rebate of 13,000 and you'd have no tax to pay. If you were over 65, you'd get an additional rebate from the 13,500, you get an additional 7,400, so that's 20,000, roughly 21,000 rand. So if you had 21,000 rand tax to pay, you'd get a rebate of 21 and you wouldn't pay anything. And then a tertiary rebate is if you're over 75, you get an additional 2,466 over and above that. The tax threshold, what the tax threshold means, it's that income below which you don't have to pay tax. So if you're below age 65 and you earn less than 75,000 rand, your tax bill will be zero. If you're over 65 and you earn 116,000 rand, your tax bill will be zero. If you're 75 and over and you earn 129,000 rand, your tax bill will be zero. That's what we mean by tax thresholds. So as long as we don't cross the threshold, we won't have a tax liability. You remember Minister Gordon said he's giving us 5.5 billion rand back in taxes? Let's just take a quick look at how he gives it to us. He's moved the bracket. See, he's moved the bracket from 181,000 to 188,000. What's the implication of that? The implication of that is that the difference between those two brackets, which is 6,100 rand, is taxed at 18% going forward. In the past, that 6,100 rand would have fell in the next bracket and would have been taxed at 26%. So the rate differential on the 26,100 rand is a 488 rand saving. And that's how he makes up the 5.5 billion that he gives back to us. So he's got 488, then he's got 475 at the next bracket, 660 at the middle income bracket, and then all the guys that earn the top, why should we give them any relief? They only pay 64% of the tax bill of the country. I mean, why must we be nice to them? We don't need their money, you know. So that's what it comes down to. So he's given us 5.5 billion relief. He's adjusted the brackets. We've taken a look at how that's worked. In South Africa, we don't have a culture of saving. We don't save in South Africa. And as a result of the fact that we don't save, it places a burden on the fiscus when our people retire. Because when they can't support themselves, that's what's there. So to encourage you to save, we have an interest rate an interest exemption, and we have a rate on that, or we have an exemption on that. If you earn only that, you get that exemption in the computation of your tax, and that's what we look at. There's been no change in it in the current year, and I think it's symptomatic of the position we find ourselves in. When, you know, if we want to continue encouraging people to save, we'll move that exemption. We can't move that exemption anymore because we need the tax revenue to come in. There's been no change in dividend tax for the year to date. Retirement reforms, there has been certain retirement reforms. I'm not going to go into it in any detail, but very simply, our deductions for anything that we contributed to retirement funds in the past were very limited. This year, as from 1st of March 2016, we get a deduction of 27.5%, and if we take it and compare it, as opposed to 7.5% or 15%, it's now 27.5%, limited to a maximum of 350,000 rand going forward. It also includes now, from the 1st of March 2016, it includes provident funds, and in the past we never had a provident fund. So me, like the Charlie that I was, I contribute to a provident fund, and I don't get anything back for it. I don't even get a tax deduction for it. From this year onwards, I get a tax deduction for it. So they may not be giving me anything in the brackets. At least I can deduct my RF, my provident fund contributions. So, you know, when you get to retirement and you've got all your pension funds in place, you can tell them, I'm retired, do it yourself. And that's what I'm going to tell the EAB when they tell me to do these courses for them when I'm retired. All right, the medical aid tax credits, the way it works is we get a tax credit. So from every tax amount that we've got to pay, we get a credit based on our medical aid contributions. And how does that credit work? The credit works that for a main member and his dependents, you have a certain credit per person, and that's set out in the table. A main member can get a credit of 286 rand per month. A main member with one dependent gets 572 rand. A main member with two dependents gets 764 rand. And then if you're like me and you got married when Mnet wasn't good and all the rest of it, and I've got 4 kids, right? I can add an additional 192 rand for every kid that is over and above the 4 kids that I've already got. So that's the tax credits. We've got a little bit of relief that comes in there, but I mean, if we think about it, it's 16 bucks, 180 rand a year, 192 rand a year that we're getting relief for per person. I suppose it's better than nothing. And again, one needs to take it into context. These things are aimed towards the lower bracket income earners. That's the reality of where we are. Trusts. I don't want to spend much time on trusts here. What I do want to say is that trust has been on SARS radar, and trust is going to stay on SARS radar for a long time to come, because trust has been used and abused to take advantage of every possible loophole that there was in the Tax Act. Now, you know, tax legislation is like any other legislation. You can't foresee every eventuality that will happen. And as these eventualities come out and reveal themselves, people, the legislation changes to address these things. Right? So from a trust perspective, we get taxed at 41%. It's the highest tax rate equivalent to the marginal income tax rate of individuals at this stage. Companies, there's been no changes in the corporate taxes with companies. Although, interesting enough, you go back to 1994, we were paying 35%. We're currently paying 28%. If you go back before that, there was a time we were paying 50%, and then we went down to 48%, and gradually we dropped. And so we're on 28%. But remember, when one takes a look at the cost or the effective tax rate of a company, you can't only look at the tax rate that the company is paying. You also got to look at the tax that you may be liable for, or the company may be liable for any money that they take out of the company. So you've got to look at those two combined, because that's what it costs you to take money out of the company. And when we look at it that way, assuming that a company makes taxable income of 100 rand, the company's got to pay tax at 28%, so that's absolutely normal. We've got 72 rand that's left after the company pays tax. On the assumption that the owner of the company wants to take all the money out of the company. So we want to take a dividend of 72 rand. That 72 rand we pay dividends tax on at a rate of 15%. So when we take that into account, we have the 28 rand, and then we have the 15% of the 72 rand, which is the 10 rand 80. So we pay total tax of 38.8, and our effective tax rate is 38.8%, as opposed to 28%. Now, if you think about it, it could be very misleading, because you're saying to somebody, I think you should have a company, because the tax rate is 28%. But you don't say to the oak what he needs to do after he's got the company is pay an additional 15% on the money that he takes out. Small business corporations, I'm not going to spend any detailed time on it. Suffice to say that we need small businesses to work in South Africa. We need small businesses to create jobs in South Africa. That's what we need small businesses for. And as a result of those of the need to promote small business enterprise, we've got an accelerated tax regime for them. You'll see that only once they make profit above 550,000 will they pay tax at 28%. Prior to that, they paid at 21%. If they make tax profit of less than 73,000, then they pay no tax. So it is an incentive to make small business work, and for small business to be able to employ people and start manufacturing and start business. You know what we need? We need entrepreneurs. We need entrepreneurs to think, to employ people, to innovate new things, ideas. Those are the things that we need. Capital gains tax. We need to look at capital gains tax, because capital gains tax impacts every single property transaction that you as the agents are going to do. So we're going to look at what capital gains tax is, who's liable for capital gains tax and when it must be paid, how it's calculated, and we look at the primary residence exemption. Capital gains tax, if we look at the movement in capital gains tax, when it started, the inclusion rate was 33%. No, the inclusion rate used to be 20%, for 25% for individuals and trusts, and it used to be 50% for companies, pre-2013. In 2013, we moved it up to 66.6% for companies and trusts, and to 33.3% for individuals and special trusts. 2016, there was no change in it. In 2017, We're now saying to people, if you look at companies and trusts, 80% of a capital gain must be included to be taxed to your taxable income. Where are we going next? All capital gains are taxable. All capital gains will be taxable. That's where we're going. If we're at 80% already, the next one's going to go, let's go to 100%. Now, what's the implication of this for us? The implication for that is, for individuals, if you make a capital gain on anything, you're going to pay 16.4% effective tax on it. For companies, you're going to pay 22.4% effective tax. And if you think about 22.4% and 28% the company's tax, that's not far off. So we need to take a look at how we deal with that and how you structure clients' affairs. And trust is 32.8%. Remember I said earlier they're attacking trusts? It's on the radar. So those are the things we need to look at. Pre-2001, we never paid capital gains tax. Any capital gains tax was non-taxable, fell outside of the tax net, wasn't included in gross income, if you remember the little diagram I showed you. Anything after that that we sold, the capital gains tax had an inclusion rate to be included in your income. The basic concept of CGT is if a capital item, in this case property, is sold at a profit, then the amount is subject to capital gains tax. So if we make a profit on capital items, we sell it. Our car. Sell a car, theoretically, we should. There's an exemption for it, but theoretically, it's a capital gain. Who is liable for capital gains tax? Residents, and I'm going to confine this discussion to South African residents. It's applicable to any capital asset of a South African resident. So anything that a South African resident has, including my father's gold coin collection, if I go and sell that collection now, it's a capital gain. Right? Doesn't matter that it was sentiment to my father and all the rest of it. I go and sell it, it's a capital gain. Non-residents in certain instances will be taxed on any capital gains in South Africa. So how do we calculate it? It's the capital gain. The capital gain is represented by the proceeds from sale less the base cost of the asset, less any exclusion that we have. We include that at the rates in the table that I had previously, and that gives you a capital gain that goes into your income that is subject to tax as per the tables. What triggers capital gain tax? It's triggered by a disposal of an asset. An asset must be disposed of. A capital gain is a capital gain or loss, because remember, as much as we can make gains, we can make losses. Is the difference between the proceeds and the base cost, including all the costs incurred acquiring and improving the asset. So if you bought a house and you spent money renovating the house and putting in new fixtures and building a pool and all of that accumulates onto your base cost. And when you then sell that asset, all those costs are taken into account, because what does it do? It reduces your capital gain at the end of the day. Let's do a quick case study. Mrs. Wright buys a holiday house on 1 June 1991 for 200,000 rand. She sold it on 30th March 2015 for 500,000 rand. She didn't value the house. Now, one of the ways you find the base cost, if you value it in October 2001. So she didn't value it, and they don't give you any other information. They say, what's the capital gain? There's three ways you can calculate the base cost of an asset. One is if that asset was valued at 1st of October 2001. Two, you deem it to be 20% of the proceeds of the cost. Or three, where the asset was acquired pre-2001, you can use the time apportionment method. And the time apportionment method says a portion of the capital gain belongs to the period pre-2001. And that is the one that we're going to apply in this one. And if we look at it, the proceeds is 500,000 rand. The base cost is the 200 that she's paid, plus the gain. The gain is the 500, the 300,000 profit that she makes. But a portion of that gain belongs pre-2001. And in this case, she bought it 11 years before 2001. But she owned it for a total of 25 years. So the capital gain, if you do the sums, you get to 332,000. The gain is only 168,000 as opposed to 300,000, right? And that 168,000 will be what is included in there. When must CGT be paid? In the case of individuals, CGT must be paid when you pay your income tax. In the case of companies who pay provisional tax, CGT must be taken into account when they do their provisional tax. VAT. I'm not going to spend much time on VAT. Suffice to say that from the property or in the property industry, one needs to have regard to the differences and the rules that is applied when we have instances where we have vendors and vendors, vendors and non-vendors, depending whether they're sellers or purchasers and whether VAT will be paid. So there's certain VAT rules where the seller and the purchasers are both not registered for VAT. They're both not registered for VAT, there cannot be any VAT on the transaction, transfer duty is payable, and that's the end of the story. Where the seller is not registered for VAT, but the purchaser is registered for VAT. Where the seller is not registered for VAT, but the purchaser is registered for VAT, what does the purchaser do? The purchaser can claim the notional input VAT on the property, on second-hand goods. That's where it comes from. What happens where there's a seller registered, but the purchaser is not registered for VAT purposes? What happens? Seller's got to pay the VAT. The purchaser is exempt from it. Where both the seller and the purchaser are registered for VAT, then it depends on the circumstances. Do we zero rate? Don't we zero rate? Is it a going concern? Is it not a going concern? Etc., etc. Is it in the carrying on of an enterprise? Then we get into all the technicalities, and that's not the purpose of this particular presentation. VAT rules where a vendor sells to a vendor of a business. Again, there we look at the rules that apply to it, and the rules regarding share blocks and loan accounts in a share block company. Share blocks and loan accounts are becoming less and less frequent. We are encountering it a lot less than we used to in the past, and we don't think it's going to be a big thing going forward in the arena. Then we've got VAT. I don't want to go through the detail of all the VAT in this presentation. You have your handbooks, you have your e-learning material that is available for download from this, and I think it's on or it's in your best interest to go through VAT on that. I think that from my perspective, I really wanted to point out to you the differences in the VAT and transfer duty rules that needs to be applied in various transactions. We can demonstrate some of that by examples. A non-vendor to a vendor. If you're a non-vendor and you purchase a flat in Woodstock from another non-vendor in their personal capacity for 1.1 million, what's the issue? If everybody is a non-vendor, then there's no VAT payable on it, and all that you've got to do is pay the transfer duty. And if you do the sums, that's the transfer duty that you get to. And we after 10,500 Rand is there, the receipt for transfer duty is issued, the deeds office will do the transfer. And I think that's an important point to show, is without the receipt for the transfer duty or the VAT, as the case may be, or an exemption of those things. So if it were less than 750,000, there'll be no transfer duty. The deeds office will not do the transfer. From a VAT perspective, when we get to developers, from the 10th of January 2012, property developers who let residential property, I've currently got a client that I work with who's built 10 of the most beautiful units. Right? Only they're selling at 12 million Rand each. There is no ready market that says, listen, we're going to put 12 million down to buy these things. So what he's done at the moment is he's let them out. And the question is SARS going to deem that he's moved from a developer who's developing for sale, because remember he's claimed all the input VAT on the development, to a property letting company. If there's a change in intention there, he would have to pay the output VAT on those units. As a result of the 2012 amendment, he now has a period of 36 months where he can actually let on the basis of waiting for it to sell. So as long as he can demonstrate that he wants to sell, he's marketing actively, etc., 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 as long as he can demonstrate all of those things, then it should be fairly comfortable for him to do it and not have to pay the VAT output on it. But when he does start selling, right, he would need to pay output VAT on each of those units. The general rule, in general, purchasing a property is subject to transfer duty, which is payable on the property unless the seller is VAT registered. So that's the general rule that we need to apply on that. That, ladies and gentlemen, is me for today. Thank you very, very much. I will touch base with you, I'm sure, on one of the other courses that I do present in the program. With that, thank you very much. Don't forget to do your multiple choice questions, get your CPD points on it, and if there's anything more, you're welcome to contact me. Thanks. Cheers.